My name is Ray Franklin. I'm the Senior Commodity Analyst for Energy Professionals. This video is going to be covering my April 13th Energy Update, which is explaining why the evidence is becoming even more apparent for higher pricing in natural gas and electricity by the end of this year. I began by referring to my March 24th Energy Update that explained that the evidence for higher natural gas pricing continues to grow. Natural gas prices are the lowest since it began trading in 1990, and supplies are much lower than the springs of 2012 and 2016 when prices were below $2. But as you can see in the charts, in 2012 and 2016, prices still approached $4 by the end of the year. In my March 24th Energy Update, I also pointed out, unlike 2012, production this year is projected to decrease. And then I closed by asking the question, where do you think prices will be at the end of 2020? In my April 13th report, I give more evidence why higher pricing in natural gas is becoming even more apparent. I base this on two facts. First, we're seeing a plunge in active oil and gas rigs. And number two, we're already seeing higher pricing being discounted in the natural gas forward markets. The number of active oil rigs have been declining over the last year, but that decline has accelerated over the last 2 weeks. We've seen a decline of 19.2% over just the last 2 weeks, and over the last year we've seen a decline of 39.5%. Now, how does that decline in oil rigs impact the production of natural gas? A byproduct of oil rigs is associated gas, and since associated gas accounts for 40% approximately of natural gas production, any decrease in oil rigs is going to have an adverse effect on the amount of natural gas produced. This, in conjunction with the fact that natural gas rigs have declined 49.2% over the last 52 weeks, virtually ensures that we're going to have much less production in natural gas this year, and that in fact the production of natural gas is about to fall off a cliff. In my report, I then ask a question. Are the forward markets already discounting higher natural gas pricing by the end of the year? And I believe the answer is absolutely yes. As you can see in the first chart, even with the lowest inflation-adjusted prices since 1990, the nearby contract has not made any headway since the end of February. Now let's contrast this chart with the second chart for the December contract. The anticipated decline of natural gas production due to the collapse of oil and gas rigs has triggered a sharp rally in the December contract to $2.80. The forward market is already discounting higher pricing by the end of the year. And based on what happened in 2012 and 2016, I believe prices will likely approach $4, if not higher. As I have said in previous reports, people that hesitated early in 2012 and 2016 to lock in those low rates paid dearly by the end of the year. And I hope you will not make the same mistake of those in the past. I hope this video helps you understand the wisdom of locking in today's low natural gas and electricity rates and not delay hoping for lower rates later on. And until my next report, please stay safe.